We are in war with Pakistan. What happens to your investments? Will your portfolio sink or survive? Let's break it down sector by sector in two possible scenarios, a short war versus a prolonged one. Wars don't just move armies, they move markets. And each sector responds differently depending on how long the conflict lasts. Let's start with a short conflict, say 1 or 2 weeks, like a surgical strike or the localized skirmish. India's defense budget rose over 13% in financial year 2024, and a skirmish typically adds 2 to 5% bump in stock prices of defense PSUs like HAL and Bharat Dynamics. Investors expect more procurement and indigenization. Even a brief standoff can push Brent crude prices up by $5 to $10 per barrel. India imports over 85% of its oil, so refinery and OMC stocks like IOC, BPCL often slide short term. Airlines saw a 20% drop in bookings during the Pulwama Balakot standoff. Flight bans, higher ATF prices directly hit their already thin margins. The short war equals mild FII outflow, leading to temporary dips in bank stocks, especially private sector banks, but fundamentals usually stay strong if war is contained. Over 60% of IT revenues comes from the US and Europe. This global diversification buffers the sector, and the weakening rupee actually improves earnings in rupee terms. No major shocks unless supply chains are disrupted. Brands like HUL and Dabur maintain rural demand and inventory buffers, so they hold up in limited conflict. Now, what if the war drags on for months? In long wars, defense PSUs can surge 10 to 20% driven by actual procurement and defense modernization. Expect new contracts and Make in India mandates to follow. Crude oil spikes to $100 plus per barrel in prolonged crisis. India's import bill could swell by $15 to $20 billion, hitting OMC profits and widening the fiscal deficit. The tourism can collapse by 50% or more, like the post-Kargil or during the 2008 Mumbai attacks. SpiceJet, Indigo and hotel chains face revenue crashes and rising operational costs. A prolonged war weakens the credit demand and rises bad loans. NPAs could rise by 50 to 100 basis points, especially in MSME and rural lending segments. Still resilient but not untouched. Global clients may delay contracts and market volatility dents investor confidence. However, rupee depreciation still supports earnings. Government may cut infra capex to fund defense, delaying major projects. Execution risk increases. Stocks like L&T and Siemens often underperform during wartime. Conflict near Punjab, Haryana or Rajasthan disrupts food supply chains and export routes. Agricultural output and mandi operations face bottlenecks, impacting rural consumption and agri-stocks. Rupee weakens. In 2019, post-Balakot, the rupee fell nearly 1.5% in 1 week. Longer wars could push it to rupees 85 plus per dollar, hurting imports. Gold surges. Seen as a safe haven, gold prices typically climb 5 to 10% during a military conflict, a hedge for anxious investors. War impacts more than just borders. It affects markets, businesses, and the money in your portfolio. Understand the sectoral risks, stay diversified and invest with a cool head. Improve your money quotient with Rupee Rakshak tools and learn smart investing. And don't forget to like, share and subscribe for more grounded market analysis. Thanks for watching.
हर घर crore India 2047